We've been quite happy in the last couple of months. The flows have returned back to India, but it's still a fraction of what they sold in the past. Do you expect more of the same? I mean, India continues to remain the preferred market, going by what all you just said as well. Earnings growth is something that stands out. So maybe these hefty valuations are justified. Your take?
So see, Nigel, one of the reasons, or maybe a couple of reasons why foreign investors have not been buying India. One is, of course, that they are still not comfortable of the valuations, the headline multiples. So we saw some correction in that between October and March, and so foreign flows have returned. The second is the outlook for emerging markets. Remember, it has been quite tepid, and we did change our view on emerging markets last October, and we continue to remain bullish going into the next 12 months. So that helps because India is part of the EM cohort. And when EM experiences flows, India gets its kind of fair share. I would say on the aggregate, foreign portfolios are slightly overweight India, but a whole lot lesser than what they used to be. India was, a very favored market many years ago. It has ceased to be in that category. I think it should attract more foreign flows. But remember, Nigel, in the stock market on a daily basis, flows are zero, right? Because if somebody is buying, somebody has to sell. The problem here is that we have a very strong domestic bid on stocks, and it's not going to go away anytime soon. So if foreign investors also want to buy stocks, and if domestic investors are buying at the same time, and if companies are not issuing capital, then you basically get a situation where share prices have to go up much more quickly. It's not a very healthy situation to be in, but ultimately, of course, those who are long will be very happy with that. They will get very quick gains. What I suspect is likely to happen is that as the foreign bid comes back on a more sustained and larger basis, I think you will see the IPO markets start to open up, and the supply will come, which will then keep price reaction more moderated. Otherwise, you get into a situation where there is a melt up, and then it all ends very badly. So that's, I think, my comment on the foreign flow situation.
That's a very perceptive, important thing. Wall of local money, right? So keeping things bid constantly, and as you said, that's not a very healthy thing. If you have a large portfolio, then you're happy. But if you're looking to buy, then you got to pay top dollar. Rhythm, let's talk about earnings growth expectations. I was looking at earnings growth for the BSE 200 group of companies. This is the top 200, which I think institutions also track. Over the last 20 years, the BSE 200 has returned 16% returns, annual returns in rupee terms, and 13% in dollar terms. If you look at the MSCI emerging market basket, the earnings have grown 7%. That's dollar terms, so 13%, almost. So basically, the growth here has been almost double what we've seen for the MSCI EM basket. What kind of growth should we expect with them, according to you, over the next many years? Will it be high single-digit growth? Will it actually pick up from here in a significant way?
So I think index returns will be a bit more modest. 16% has to be seen in the context of what inflation India had in that period and what interest rates India had. I think the next 10 years, both of them will be lower, and therefore stock market returns will also likely be lower than the compounding we've seen over the last 20, 30 or even 40 years, because that number of 16% goes back even 30 years or 35 years. In fact, if I'm not mistaken, the Sensex data that I have goes back to 1980, and we'll probably have a similar number for a 40-year period, which is that the Sensex is compounded at around 16% or so. So I would imagine that this number will moderate into the next 10, 15 years. It will be more like 10, 11 or 12%. And that will be in sync with the lower inflation rate India should experience or lower interest rates. The equity risk premium, which is the gap between the equity return and the risk-free rate, that I think will be more or less the same. But the nominal returns, I think, will be lower than what we have seen over the past 20 or 30 years.
Okay. Another piece in your report which was very interesting to me is the talk about the Indian energy boom, right? And I think this is 1 year where this entire space is expected to come out on its own, because the last few years, although there was a lot of potential, there are still some lingering concerns for adoption of renewable energy, whether it's supply side bottlenecks, the grid infrastructure, pricing issues, etc. But from your perspective, what does this piece look like over the next couple of years? And which are the companies or which are the spaces that could be big beneficiaries of this?
So India has got a huge amount of commitment to renewable energy. We have a COP26 target to achieve. And therefore, our view is that over the next 10 years, renewables will dominate the total energy capacity addition. Our estimate is that 2/3 of the incremental energy requirements in India will come from renewable sources. And India's own energy requirement is going to grow leaps and bounds. So one of the numbers that I have cited in the recent past is that the per capita daily consumption of energy in this country is about 800 watts, which is meaningfully less than the light in your room right now. That's the per capita daily consumption. For comparison, in the US, that number stands at 9,000 watts. It's 12 times more. India will probably go to 1,300 or 1,400 watts in the next 10 years, which is a huge jump. I don't think there are too many countries that will experience a 60% increase in per capita daily energy consumption. So India will need more energy and it will invest in more energy, and you're already seeing that. So companies that supply equipment that enable generation and transmission of this energy to the end consumer are obviously going to see very strong order books. And you can already see that in the commentary of such companies. They're already talking about it. So I think that's going to be a very exciting place. Whether stock market investors make money or not is a totally different ball game, because you have to check what's in the price and how much of that order book actually translates into earnings growth. So there are two things to check. And that may vary from company to company or sector to sector. But I think it's a very interesting and exciting space in the coming 10 years.
Okay. One final question, Rhythm, before we let you go. You have your conference that kicks off today. How are you feeling about it, and how is the environment in general? Is there a big pickup in terms of both, activity as well as investments within India? Because we were just speaking to a guest a while back, a global guest, who said that now the narrative is people have gone a bit underweight on global equities and India is looking like a great piece, which of course is your view as well. But what about the conference? How is it looking so far?
See, Sonia, I think that's an interesting question you ask, and I would actually step aside from just this conference. My interactions with global boards and global investors has been the highest in the last 6 months, and cumulatively more than what I did in the last 10 years. So the level of interest in India is unprecedented, and it's bound to get converted into flows, both FDI and FPI. So I would be hyper bullish on how much demand there will be for Indian assets over the next 3, 4, 5 years. There are a few risk factors we should not forget. I mean, India still has to deal with a general election that's coming up next year, and we have to hope that India votes in a majority government. We have a potential, it's not our base case forecast, but a potential global growth slowdown and a recession, which we'll have to negotiate. But, keeping those things aside, I think the long-term story of India is certainly attracting eyeballs. And there's a huge amount of interest in India, which I've never seen before.
Okay, we'll end on that optimistic note, Rhythm. There's a huge amount of interest in India, which we have never seen before. Hopefully, it'll bode well for the equity markets as well as, in general for the macro economy. Thanks a lot. Great pleasure speaking with you.